Our next presenter with us today is Gary Santo, Chief Executive Officer of Tilt Holdings. Tilt shares are traded on the NEO exchange under the ticker symbol TILT and on the OTC exchange under the ticker symbol TLLTF. Tilt has a very unique strategy within US Cannabis. Through its cannabis segment, Tilt utilizes its production assets in states with limited license regulations to produce its own branded products as well as third-party brands. This uniquely makes Tilt one of the few operators with a white label service in key cannabis markets, offering Tilt growth opportunities and flexibility within its cannabis segment. Moreover, the company also owns Jupiter Research, one of the leading cannabis businesses in cannabis vaporizer hardware design, research, and manufacturing within the US. This segment provides Tilt with broad exposure across much of the US cannabis industry and international markets, where it distributes its vapor technology broadly. With that, I would like to turn the call over to Gary to discuss the business of Tilt Holdings. Gary, over to you.
Great, thank you, Andrew, and thank you for having me. And I thank all of you who are listening in today for your interest, both not only in Tilt Holdings, but in all the different companies out there, because I do think this is a unique time in the cannabis market space. Certainly the sector has had its ups and downs, rocket ship ups, unbelievable downs. But it feels like the good operators are really starting to separate from the group. And if you just look a little deeper into some of the off the run stories, you start to see there's some real good operations coming along. And I'd like to think that Tilt is one of those. So with that, I'd like to jump into our presentation. Let me just see if I can get this to work. There we go. Okay. This presentation is available on our website, www.tiltholdings.com. So rather than do a complete page flip, I think I'm going to jump to some of the key pages that really drive home the story of who Tilt is. Tilt went public back in 2018, and like many of the cannabis companies that went public around that time, their mandate was fairly broad. There was vertical integration on the plant touching side. There was an idea about technology, software services, distribution, financing, management, and oversight. So pretty much the gambit of everything you could possibly do as a cannabis operator. Not surprisingly, that was too broad of a mandate really for any company to try to do and do well. So over time, we had a very active board that really saw through to where some of the key assets lied and went about the business of reconstituting the management team and refocusing really where the company was going to head. We were lucky that we had accumulated a number of really key assets along the way. I'll talk about some of those. Half of them are on the plant touching side. The other half are on the non-plant touching side. And as we came through sort of a rebirth in 2019 into 2020, certainly as the market was turning around, we really exited 2019 as one of the few cannabis companies at that time who was able to finance its operations out of its cash flow from operations. So we weren't borrowing, we weren't selling things, we weren't diluting our shareholders anymore. The last capital raise this company did was in 2019, and every dollar was spent on refinancing existing debt. So it was about streamlining, it was about bootstrapping. I heard Eric talk about that earlier. It was about getting back to fundamentals and having responsible growth each step of the way. So really what makes Tilt so different is we do operate in multiple states. There's no doubt. We have our plant touching and non-plant touching pieces spread throughout the US, but our focus is not so much on the retail side. We have certain retail licenses in Massachusetts because you have to, but ours is more of a B2B story where we're out there supporting the MSOs, we're supporting the LPs and the cannabis brands pretty much throughout the world. So, whether it's on a bespoke basis where we're doing a custom product for you, whether it's on a white label basis where you're taking one of our products and putting your label on it, or whether it's just coming through with some of our own brands, our job is to try to have a broad range of options and a portfolio of products that allow the MSOs out there to fill the other 30% of their shelves you often hear them talk about. Most of them do support about 70% of their own brand, but they know to keep their customers in-house, they need to have a few more brands other than their own. Our goal is to be able to provide those brands on a partnered basis. Part of the reason for this particular strategy is we believe CPG is coming to this industry. The vertical integration story has certainly worked to this point, and it's been necessary. With the regulatory regimes the way they are, you have to run vertical operations in any state that you're going to be operating in. The issue you tend to have there, however, is the overhead associated. To be in 5 or 10 or 15 different states, you have to run 15 independent businesses, and economies of scale are hard to come by. That said, as we start to look towards the potential for a fully legalized market, we think not only could grow suddenly become commoditized, where mainstream growing is picked up by the big agro shops, but we think retail could also become commoditized. People like to buy online. People like to buy at big box stores. So the need to have all these small independent genius bars, if you will, of dispensaries out there could become a bit of a weight on some of these fully vertical shops that are floating around out there. So for us, we think brands will start to make their way from the West Coast to the East Coast. We've certainly started to see some of that. You've seen Cookies making its foray to the East Coast. We've partnered with Aero Brands. We partnered with 1906, Old Pal, and Her Highness to do the exact same thing, to help them bring the CPG brands that they have from the West Coast to the East. And that's really because it is difficult to scale a brand. You might be a top line brand in California, but what makes you top line there might not necessarily work well on the East Coast, because here in the East, we have limited licenses. We have different regulatory regimes. We have medical markets that are still waiting to go to adult use. So it could be your packaging, could be your formulation, could be your form factor, could be how you actually market the product out there. That all needs to be rethought in terms of how to bring that brand from West to East. Certainly with Old Pal, that's been a great learning experience, I think, for the brand. Our job is to make sure we're experts in the field, in the states that we're in. So Massachusetts, Pennsylvania, Ohio, and soon to be New York, so that this way the brands don't really have to think about it. So what's our value proposition? Really, it's 4 key components. And again, you can split these into plant touching and non-plant touching. But we offer wholesale flower and consumer packaged goods. This is predominantly in the states where we have cannabis operations. So again, Pennsylvania, Massachusetts, Ohio, and soon to be New York. We could offer packaged goods in a number of varieties. Our wholesale flower, we've started to notice, I think, in these states, as more and more grows come online, the sale of bulk flower is starting to fall away, and more packaged goods are coming up in place. So the ability to turn that pound of bulk into a bunch of eighth packages, I think, is important, and that's something we do and do well. We also offer hardware and packaging. So again, this goes to our non-plant touching side, the inhalation and the accessories. So that could be the vape power packs, the empty cartridges, packaging not only for the products themselves, but also for cannabis products. So whether it's to put the different cannabis edibles in, to put the flower in. We also offer product development, and this starts to become important in these brand partnerships that we have. So that's where we work across the board, whether it's in our hardware and packaging departments, whether that's at our plant touching departments, to really work with our brand partners to determine what it is they're trying to do, what is critical to their brand, and what is the integrity and fidelity of that brand, and how can we support that, whether it's with our packaging, whether it's with our sales and product development. And I'll talk a little bit more about the types of partnerships we have where really product development is almost as important as the partnership itself. And then the last piece is the contract manufacturing and distribution. And this is something that I think is a little bit of a differentiator. Typical contract manufacturing, you pay a licensing fee, and then you start to produce the product based on a series of SOPs. You're not necessarily responsible for the distribution. You're not necessarily responsible for the sales. That really falls back to the brand that's contracting with you. We offer a turnkey approach. What we allow our brands to do is to come into our markets. And in Massachusetts, for example, we sell north of 50% of the retail outlets, as well as our own stores. In Pennsylvania, it's more like 90% of the retail outlets. So we offer you access to our sales infrastructure, so that if you're a brand, you just need to know what you're trying to reach in terms of your brand itself. Are you a high-end premium? Are you a value play? Are you somewhere in the middle? And what is the demographic you're looking to hit? All you'll need at that point are a few brand ambassadors. You can have access to our sales staff as well as our production staff, so that with a very low investment on the part of a brand, you can now sell into those 90% of the retail outlets in Pennsylvania and 50% in New York. So when you look at the package together, it's a front to back opportunity for brands, for MSOs to really look at the things they do well, look at the things they'd like to do, but maybe don't have the capacity to do right now, and look at how to spread their footprint out beyond just the four walls of their own organizations. And we offer that on a turnkey basis. The result is really complementary business lines that really speak well to each other. So as you might expect, not every customer who works with us on the inhalation and the packaging side is necessarily a plant touching customer. But over the years, we have had a fair amount of crossover. In fact, we began this year, about 20% of our revenue came from customers who both had the hardware side and the plant touching side. So we'd sell them the hardware from our inhalation department. We would then bring that over into our cannabis operations, fill it, package it, and distribute it for folks. Since we've announced our brand partnership B2B strategy earlier this year, that number has now grown from 20% of our revenue to 30% of our revenue. And that is largely because of the large customer base we're able to reach. On the inhalation side, we are one of 4 distributors of C-Cell technology. That is the ceramic coil and heating element that is used in the vaping business. It is by far one of the gold standards out there, one of the largest ones out. We're about 50% of the C-Cell market. The other 3 distributors sort of drop off significantly from where we sit. From that, we're able to leverage about 700 different customer relationships. And again, these are MSOs, these are LPs, these are independent brands. And we're able to begin our cross-selling process. So it's a lot of green growth for us on that perspective. Green fields ahead, and we look forward to what we can do from there. In terms of where we are in plant touching, we sort of have a Northeast corridor that we've developed. We're not trying to be all over the country. I think if you look sort of west of the Mississippi, that's a different sort of animal altogether, and a place that we probably wouldn't expect to play in any meaningful size other than with our hardware and our packaging. But we're in Pennsylvania, we're in Massachusetts, Ohio, and soon to be New York. Massachusetts obviously has medical and adult use, continues to be a growing market. I think you're seeing a maturation of that market, more and more flower coming on. There's more access to biomass, which is exciting for us because as we think about how to be as efficient as possible with product and development, especially with these brands coming in, knowing that we can source certain amounts of biomass and then really dedicate our grow to the high-end quality flower is a bonus for us. Similarly, in Pennsylvania, there we don't have retail operations. They are just purely wholesale. It's medical. It's poised to go adult use. It's certainly a market that had a lot of fanfare a year or so ago. It had grown exceptionally large. To get a medical card, you could have any number of conditions. I think one of the limiting factors there has really been the form factors they allow. So you cannot have edibles, you can't have pre-rolls, can't even sell rolling papers, frankly. So as that market begins to expand its demand and starts to think about adult use, I think you're seeing sort of that move away from just pure vapes into premium flower, into other forms, capsules, suppositories, and other items out there. So really, as the form factors start to grow, I think we expect that market to start to pick up steam again. Ohio is one where we have manufacturing. It was a new addition to our portfolio. We took ownership of it earlier this year and doubled its capacity. We now have about 20,000 square feet. We have a kitchen. We have a full processing lab. And there we are just starting to roll out about 4 or 5 SKUs right now. I think that's a market that it's medical only. While it's a little bit more difficult to get your medical card, certainly the form factors are much more robust. So there, the number of SKUs you have are going to be important, and we're excited to bring our brand partners into there. And then New York, obviously, is the one that everyone's been looking towards, with adult use really on the horizon once they get their cannabis commission set up and they can codify some of this. I think everyone's excited for how big New York could be. And I'll talk a little bit more about the unique aspect of that particular arrangement. As I mentioned, here we are. We took a different approach. Again, because we're not focused on retail so much, our concern about having limited retail operations in a certain part of the state was less important to us. We're looking at the potential for wholesale and to be able to reach the entire state. We're also very big proponents of social equity. So through an investor, we were introduced to a group called Connor Green, and they specialize really in working with Native American tribes who have been contemplating doing something in cannabis. And they had been working with the Shinnecock Nation in Eastern Long Island since I think about 2015 or 2016. And they had been methodically developing a cannabis program while they have their own cannabis commission on reservation lands, and they can certainly write the code any way they choose to, they've decided to really try to mimic, exactly. I don't know why this just changed. Let me go back one. There we go. They wanted to mimic what was going on in New York State. So this way, when the time should come where wholesale is allowed and adult use is allowed, not only would you be able to go onto native grounds to purchase your cannabis, both in adult use and in medical capacity, but we would also be able to sell those products across the border. So it was an exciting opportunity. I think for us, what made it really intriguing was, unlike a lot of MSOs who look at these type of social equity deals, it was important for us that the Shinnecock be the ones who own this facility from the start and throughout the entire process. Typically, when you see MSOs get into these types of things, they'll fund it, they'll finance it, they'll help manage it, and at some point, there's always a path that allows them to take ownership of it. That's not the case here. We're excited to be able to build out a true economic ecosystem that will help give back to that community for years to come. And we will train up the population. We'll do our best to employ as many folks there from the native grounds and train them up into what it means to have a true cannabis operation, not just on the dispensary front, but on cultivation, on manufacturing, on distribution. So we're excited about that. The best part is we're able to get in for very low money. If you look at other deals that are being done out there, people are spending tens of millions of dollars just for the right to try to get into New York and then spend more money, whether it's building out an asset they just purchased from somebody else, whether it's trying to expand their existing footprint. For us, it was about $700,000, about half of which was cash, the remainder was equity. And even if Connor Green hits every single milestone between now and when we commence operations, you're talking about another $2.5 million in equity, and only equity. So every dollar we're putting out right now is to build the operation that will generate cash flow. And in terms of what that means to us, we'll be able to receive revenue both from the top line revenue from the day the store opens, about 11.25%. We'll be getting our loan paid back at about a 9% interest rate from cash flow from operations, but then we'll also have about 18.75% call on free cash flow. So it's a very robust amount of cash. The majority of the cash is still going to the nation. That was very important to us. So it checks the box for social equity in a real and meaningful way. It checks the box for a very efficient way to get into a very robust market, and it allows us to really focus on how to bring our brands and brand partners into this particular state and expand the business. I talked about Massachusetts, 100,000 square foot facility, half of which is cultivation. There we have 3 retail stores, one of which has been operating for the last 2 years of medical only. We just recently received our provisional license for adult use and had our final inspection. So we hope to have adult use and medical in our location in Taunton, which is attached to our cultivation facility. We also have a facility a few miles away, again, still south of Boston, in Brockton, that was recently approved for medical and will be opening up in the next few weeks. And just completed its adult use final inspection to go with its provisional license. And we hope to add adult use there later in the year. So medical in the next few weeks, adult use before year end. Finally, we have a medical store in Cambridge. That one right now is awaiting its final inspection to commence operations. Probably don't expect that one to open up until early 2022. In terms of Pennsylvania, I talked about that already. It's a greenhouse operation. High-tech greenhouses there. We sell into about 90% of the dispensaries out there, whether it's MSOs or whether it's independent retail dispensaries. We're agnostic. So we bring pretty much the full gamut of all the things we can offer there. Ohio, as I mentioned earlier, it's manufacturing at this point. I think that's something we could look a little deeper into, as the prior panelists talked about, is how do you grow in Ohio? I think maybe looking to get control of some cultivation might not be a bad idea. But I think at this point, we've been very intentional about how to grow. What's important to us at the end of the day is not to ever become a competitor to our customers. We want to supply them. We want to support them. We don't want to compete with them. So yes, we have our 3 stores in Massachusetts, but it's more than likely that we will share our shelf space more than a typical MSO might to our brand partners and our MSO partners, and really help them expand their reach. Lastly, talk a little bit about our inhalation group. So, I think our Jupiter division, Jupiter Research, has been a leader in inhalation. I think one of the things that makes them so unique is their dedication to R&D. They're not just a distributor. They were instrumental in helping bring C-cell technology from the tobacco side into the cannabis side of inhalation. Our founder, Mark Scatterday, was instrumental in that from an entrepreneurial and a design and invention side of things, and worked tirelessly with the factory back in Shenzhen, China, to be able to bring that technology in. And really that's allowed Jupiter to maintain a very important role in that relationship with the owner of the C-cell technology, in that we have co-located R&D facilities. We have people on the ground in Shenzhen, China, providing QA and QC for the R&D teams over in China. Similarly, Smoore has some of its own employees sitting in our Arizona headquarters, sharing our lab space and working collaboratively on joint IP. We're also the only distributor in the US who does the warranty claim work and tech support. So, we are there to provide more than just a vessel through which someone can buy our different C-cell products. You might be familiar with Curaleaf Select. If you look at C-cell products, it's a Jupiter cartridge, Jupiter battery that powers that. Obviously, they fill it with their own oil. And we continue to see that most of the MSOs, when they're putting out their flagship brands, such as Select, they do tend to look to C-cell. It is a bit more expensive. It's the premium brand out there. But when they're putting their name on that, on their premium side, they want to make sure they've got the Cadillac, really, of vape hardware. And then, of course, I talked about the innovation and the full lab that we have in Arizona. In terms of where we are financially, as I mentioned earlier, we are fully funded out of cash flow from operations. I think we were very methodical over time with how the business was rebuilt. Certainly, as we came out of the vape crisis in 2019 into the respiratory pandemic of 2020, if you looked, you would see our revenue growth from 2019 to 2020 was really relatively flat. But if you looked at our EBITDA growth, we went from being negative 1 million EBITDA to positive almost 17 million EBITDA. And that was really all about right sizing the business and really focusing on the core businesses that were driving potential growth. As we look ahead, the nice part about the investments that were made prior to this year is that it allowed us to have fully built out operations. So all of our retail stores are fully built. They're just waiting for the licenses. Our cultivation and manufacturing, while they do require some maintenance capex, we're talking in the hundreds of thousands of dollars, not tens of millions, because again, they're fully built out. So, you're talking about upgrading a machine or upgrading a lighting system, not having to add an actual capacity. The only real meaningful capex facing us will be what we do in New York as we spend the time and the money to build out the operation there. We'll design it, we'll control the build out. But really for 2021 and into 2022, our existing assets are poised to give us some significant growth. So again, this is the dynamic I was talking about earlier from 2019 to 2020. You can see the kind of growth we had on the EBITDA side and the cash from operating activities. As we look forward to accessing the capital markets, I think what you'll see there is a very opportunistic approach. Earlier this year, we were able to launch an ABL, an asset-backed line, supported by our non-cannabis inventories. I think that was a very important $10 million line. It came through at prime plus 3.5%, very favorable rates. We do have a little bit of debt on our balance sheet that we will be looking to refinance at some point. Again, being opportunistic, none of it comes due until the earliest 2022. So we think we have some opportunities there to look at what the market's giving right now, because the debt markets are pretty robust. So in summary, what we offer is a unique multi-state international operator focused on B2B. We give you plant touching assets and non-plant touching assets. So it's a nice hedge, very slow and steady growth on the inhalation side, explosive growth with high margins on the plant touching side. Our ability to internally fund growth and be opportunistic about accessing the capital markets, and tremendous opportunity for expansion in the multiple markets. With that, I will open up the remaining time to Q&A. Again, you can find this presentation on our website, www.tiltholdings.com.
Great. Thank you very much, Gary, and an excellent overview of the business. My first question is on the white label side of the cannabis operation. How do you manage that potential conflict of interest of having your own brands in the marketplace, alongside some of the white label products that you offer? Like how do you manage, which brands you market, which brands you put on your own store shelves? How does that play into your decision making?
Sure. So we've developed a grid that kind of looks at the various levels of price points and quality points, and then how many different form factors can you really have? And of course, that is informed by what's allowable in each of the sections. Our goal with our home house brand, which is Standard Farms, is really to have that fill in the gaps wherever our brand partners, our MSO partners are not able to touch. So as a lot of these MSOs are using, their grow space for premium flower to sell premium flower, when it comes to capsules or things like that in Pennsylvania, for example, we're happy to step in and offer that either on a white label basis. It could be a Standard Farms branded basis, or if we're bringing in a third party brand. So again, our brand is there to support and fill in gaps. We're not trying to make Standard Farms a preeminent brand because frankly, that's an expensive proposition. And to do that in scale and nationwide is very difficult. I think I talked about that Northeast corridor. I love having all of our operations within a few hundred miles of each other, so we can start to have some centralized heads of cultivation and heads of cannabis operations. So even though I can't cross state lines just yet, when that time comes, everything's in one spot. So when we bring our brands in, we make sure they fill a spot on that grid. And frankly, it's a spot that's either underserved, that we know there's tremendous demand for, or really as these markets mature and you see price competition, especially on the wholesale side, if these are brands that successfully were able to hold their position in California, where it's clearly super competitive race to the bottom, then that type of architecture coming east are probably giving us access to retail price points that we couldn't touch on our own, and our brand partners and our MSO partners probably couldn't touch on their own. So a higher starting point, even though we're sharing some of the economics, still yields, I think, what is a very consistent and sustainable business model.
Great. And now we have a question from the audience that I'm going to merge into one of my own questions here. I want to look at the New York marketplace, and my question is, how large is the New York adult use market opportunity, potentially several years out, and how will Tilt, through the partnership agreement you have there, be able to capitalize on the wholesale opportunities within that state?
Sure. So just yesterday, Shinnecock announced that they had a vote and they approved adult use on their native grounds. So if that was a functioning dispensary right now, if everything was built out the way we anticipate building out in the next 12 to 18 months, we would be the only entity selling not only medical, but adult use really in the state of New York. And people can come onto the native grounds and they can leave with product. Obviously, there's certain regulations around that. Our longer term view, though, is that at some point wholesale will be permitted. In fact, the state has been very vocal about wanting a dispensary built on Shinnecock lands and being able to wholesale third-party product in there. So our government affairs folks are working hard together with New York State to try to figure out what will that wholesale look like. When will that code be written, so that this way we can start to sell out off of the reservation lands throughout New York State. Certainly, we saw what we've done in Pennsylvania, where we touched 90%. We saw what we did in Massachusetts, where we touched 50%. I have no doubt that if once adult use is up and running in New York State, it'll be every bit as robust as Massachusetts. People are saying it's going to be the next biggest market next to California. I think there's tremendous ramp and runway there. So that's really why we did this. When we ran the numbers, frankly, it still looks very attractive, even if all we ever do is sell out of that one dispensary or even add a second dispensary on Shinnecock grounds. But if we can open up those doors and be able to wholesale product to the broader market throughout New York State, that's really where things start to become a lot more fun.
Thank you for your insights there. I think we have time for one more question here. And I do want to touch on the inhalation business as well. Yep. Within that segment, what do you see as the most important growth drivers for that segment? Is it through R&D? Is it through new product launches? Or is it through monetizing and better penetrating the existing market opportunity?
I think there's two pieces. I mean, it's been a very steady business. I think we're happy to see a return to sort of pre-COVID levels for purchasing. And some of that's been just by form factor, in the sense that, I think all-in-one disposables were something that fell by the wayside when vaping started to contract a little bit last year, because the convenience wasn't necessary. Tourism was down in most of the states where the all-in-ones were most popular. You certainly didn't need that utility if you were working from home, and you tended to see people migrate towards smokable flower away from the vapes. But now they seem to have come back, and we've seen a huge pickup in those all-in-ones. I think R&D and innovation are going to be key, because the other piece we've noticed is, I think the existing concentrates and the flavors where you've seen sort of, the peach mangoes and things like that, there's still a place for that, but people are moving more towards the natural terpenes. They want a more authentic look and a feel and a taste. So you're seeing the live resins, you're seeing the rosins, the waxes, the shatters, all starting to come into the vaping space. And that's going to require a different sort of device, I think, that will allow you to really get that as close to a plant flavored profile as you can possibly get, while still having some type of a concentrate, as opposed to pure smoking the pure flower. I think there's also an opportunity for heat not burn. I think that's one of those holy grails out there. Can you do it? Can you do it well? Because there are just certain things that combustion provides to the flower that just heating it, may or may not be able to do. So we're excited to work collaboratively with the factory. I also think the other piece is looking at the fact that a lot of these MSOs are developing two different lines. They have their high-end line, their premium line, and they're definitely going down the path of C-cell. I think you're seeing, they're tending to have more inexpensive lines out there for the everyday person and user, and the ability to really create products that will fulfill that gap. We've seen some of the other distributors on the C-cell side start to carry those other types of products. I think we could start doing more R&D and carrying those products as well.
Great. Thank you so much, Gary, for joining us today. As always, you've got excellent insights, both on the business and on the overall industry as well. So appreciate you taking the time to share your thoughts on
Pleasure.
Tilt
Thanks for having
and
me.
the US cannabis industry today. Thank you.
Thank you so much, Andrew.